guys, welcome to Talking Money with Nozi, personal finance made simple. Today's video is about the mistakes that I made as a beginner investor, and hopefully you can learn from my mistakes and make better choices with your own investments. Mistake number one was not having investment goals, and this mistake led to other mistakes, as you'll realize. When I started investing, I didn't realize that investing is not a game. What you invest in, how much you invest, and for how long you invest will determine your financial outcomes. So the way I approached investing in the beginning was too relaxed, no direction, no strategy. And as I have said before, investing is like going on a journey. To end up where you want to go, you must know where you are going before you catch the bus or the taxi or an airplane. So before you start investing, you must know what it is you want to achieve, how you're going to achieve it, and when you want to achieve it. Your investing goals are your roadmap that will guide what you invest in, how much you invest, and for how long. Without your roadmap, you will most likely not reach your destination. Mistake number two was not educating myself enough about how investments work. When I started investing, I thought that all I had to do was open an Easy Equities account, deposit money, buy a few shares and ETFs with the expectation that my investments would go up and keep going up all the time. But as time went on, I realized that there were so many questions that I had and so many things that I didn't know. I had to dedicate time to learn how the stock market works. Luckily, when I started investing, I started with very small amounts of money that wouldn't have been devastating to me financially if my investment choices were a complete disaster, which some of them were. But what I've learned though is that it is not possible to learn everything about investing from a theoretical point. Reading books is good, watching financial YouTube videos is good, but you will only learn some things by experiencing them. For example, I read about significant stock market crashes in the past, like the 1929 crash at the start of the Great Depression, the Black Monday crash of 1987, the dot-com crash of 2002, the 2008 global financial crisis, for example. But nobody can teach you the kind of emotions and the thoughts that go through your mind when you experience an actual market crash as an investor. Like the March 2020 crash was the first time I experienced a market crash since I started investing in 2017. Luckily though, all the reading that I had done prior to that did help because I didn't go into a panic and sell all my investments, but I do remember feeling very unsure and uncertain because even though theoretically I knew that this was the best time to buy shares and ETFs because everything crashed, the prices went down, right? But emotionally, it was scary. So even though I didn't sell my investments, I didn't buy anything because I was just too scared. I didn't know what was going to happen. But as you all know, the markets quickly recovered in April 2020. Huge regrets on my side, of course, because I missed out on the sale of a lifetime. So I thought. But I guess I'm lucky because the markets crashed again in June 2022 and they still have not recovered even now. But this time around, I was more mentally and emotionally prepared, and I have been investing every month throughout 2022. Mistake number three was buying shares and ETFs only when they were green. Like only when I thought they were performing well. So guys, this is what I would do. I'd log into my Easy Equities. I didn't have a watch list, had no clue what to buy. I'll click on this here. Check the graph. If it's green, then it's a potential buy. And I'll keep on doing that. So let's look at this one. If it's red, stay away. I wouldn't even look twice at it. I'll click again on another one. If it's red, move on. Click on another one. If it's green, it's going into my potential bucket. Yo. The reason why I'm laughing is because guess what? Most of the shares and ETFs that I bought when the graph was green eventually turned red. I was hit with so much confusion, like what is going on and what must I do? That's when I learned that, oh, investments don't go up all the time. The graph is not always green, right? I also learned that it is normal for shares, ETFs, whatever is on the stock market to fluctuate in price. The price goes up and down all the time and I can't do anything about it. I can't control it. So I had to learn the proper way of choosing shares and ETFs, and it wasn't based on green or red graphs. Not at all. Mistake number four was buying too many ETFs. So Early on in my journey, I read and quickly learned that ETFs are one of the best ways of investing in the stock market. So excitedly, with this new knowledge, I bought dozens of ETFs, like literally. This was a mistake because you actually don't need a lot of ETFs, especially if you buy diversified ones like the top 40, the S&P 500, the total world or MSCI world ETFs. Those are enough diversification. The more ETFs that you buy, you end up overlapping the companies because most likely you're going to be buying the same thing over and over again. And at that point, diversification becomes diversification because you are spreading your money too thinly, paying too many fees for the ETFs instead of picking a few diversified ETFs and concentrating on adding more money on just those few. Mistake number 5 was falling for the dividend trap. This is a classic beginner mistake. So a dividend trap is a company or ETF with an unusually high dividend yield, either because the share price has recently fallen very badly, or the company or ETF is a slow grower. So it's going to pay you a dividend, but the share price is not going anywhere. This is a mistake if you want to invest for the long term, because for the long term, what makes a huge difference is capital growth, which is the increase in share price or ETF price over time. Capital growth is what will make your investments grow over the long term. Dividends are just the icing on top of the cake. And based on my experience, there's usually an inversely proportional relationship between dividends and capital growth. Most ETFs and shares that pay very high dividends, they don't grow much in terms of share prices or capital growth. But the companies that pay lower dividends or moderate dividends usually have really good share price growth. Let me give you an example with my investments. I'm going to start comparing Verizon with Visa. Now, I know that these are in completely different industries, so I'm not really comparing apples with apples, but the point that I want to show you is that the higher dividend companies are not excellent growers from what I've seen. So Visa is a better grower than Verizon, but Verizon pays a much higher dividend than Visa. So if I go to Yahoo Finance, you see that Verizon's dividend is 6.6% and Visa's dividend is only 0.85%. But look at the growth. If I just drop down here, so you can see the growth since 2017 for Visa is 122%. This is the share price growth, right? But look at Verizon. Verizon's growth since 2017 is actually negative. It's the dividend trap. Let's have a look at T. Rowe Price. So T. Rowe Price also pays quite a high dividend in American standards because American dividends are quite low usually. So T. Rowe Price, it pays 3.86% in dividends. Microsoft, which I'm going to compare it with, only pays a dividend of 1.1%. But look at the performance long term. So if I select T. Rowe, click on Max. So since 2018, T. Rowe's share price has increased by 17%. But look at Microsoft. If I look at the same time period more or less, the share price has increased by 250%. Let's look at Pfizer. And the dividends that Pfizer pays also quite high in American standards is 3.28%. And let's look at Lowe's, which is what I'll compare it with. Lowe's dividend is 1.96%. Let's look at the performance. If I click on Pfizer, Max, since 2017, Pfizer's share price has increased by 43%. Let's look at Lowe's. Here we go. Lowe's share price since 2017 has increased by 175%. So do you see what I mean? Mistake number 6 was not having an investing process or strategy. This is very similar to mistake number 1. Not having an investment strategy or process. It leaves you open to FOMO, fear of missing out, the opinions of others. Buy this, sell this. It will lead to buying high, selling low, lack of direction. Developing an investment strategy needs you to know yourself as an investor, what you can and cannot do, as well as your own financial goals. Our goals are not the same. You need to ask yourself questions like, do I enjoy going through financial statements of individual companies in order to choose shares for yourself? Be honest, guys. Or do you prefer a more hands-off approach to investing? Actually, there's research that shows that hands-off investing, where you buy low-cost diversified ETFs every month and go away, is the most suitable way of investing in the stock market for most people. So if you are a beginner or you're not interested in keeping up with company financial reports and business news, etc., you will do fine investing in ETFs. Another thing that you have to do is figure out how much you should be investing every month in order to achieve your goals. Because guys, let's be honest, investing 50 Rand or 100 Rand per month is not going to help you to achieve your goals of financial independence, paying for your kids' varsity fees, or being able to retire comfortably, because 50 Rand is too little, right? The rule of thumb is that you should invest a minimum of 15% of your income every month, starting at the age of 25. So that means if you are starting at age 30 or 35 or 40 years old, 50 Rand is definitely, it's not enough. And even 15% of your income may not be enough because of the time that has passed. This is not to discourage anybody. Please invest whatever you can. But at the back of your mind, you must be aware that the minimum investment for a 25-year-old is 15% of their income. And if you're much older than that, you must make a plan to increase your investments to above that. Personally, I'm currently investing 30% of my income every month because I'm no longer 25. I didn't start at 25. I started in my 30s. So I'm playing catch up because of lost time. Mistake number 7 was not investing early. And I think of all the regrets that I have, this is one of the biggest ones. Because when it comes to investing, time is your friend. Time, guys. The longer you stay uninvested, the more time you lose and the less time your investments have to grow. So if you are watching this video, please don't procrastinate. Take action now. Start with the little that you can afford, right? And increase your investments as you pay off your debt and as your income increases over the years. Don't cheat yourself, guys. If you can afford to increase your investments, do it. If you want to start investing and you need help, I wrote easy to read ebooks about investing for beginners. You can go over to my online store to get yourself a copy. Please see the link to my online store in the description and comment section below. Okay guys, that's it for today's video. I hope you've learned something valuable to help you with your own investment journey. Please write your own investing mistakes in the comment section below so that other people can learn as well. Remember to like this video and subscribe to my channel for more content. Until next time, bye guys.